feel like Mr. Rogers and still putting on my jacket. Let's put it on and get this show on the road. Let's see. How come I'm not? That's weird. There we go. Let's see if I get a bigger picture. Uh-oh. All right. Welcome to another wonderful broadcast of the Housing Debrief. And this should be fun. That's for sure. I hope everybody had a fantastic week. A lot of going on in real estate. Already finished a quarter of the year. The first quarter is now said and done, and now we move on to the second quarter, April 1st. I was going to tell everybody that we had a lot of inventory. April Fools, right? But you know what? I don't want to kid around with something like that because there's, in all seriousness, there's a lot going on in real estate, and there's a lot that's being said about real estate. So I just want to make sure that we just cover all the bases and give you the straight scoop. I don't want to pull anybody's leg today on April 1st. Let's see. So I'm going to go ahead and share my screen, and let's get the show on the road. And here we go. Let's see. Got a pew. I have been waiting for this talk all day. Well, all right, Susan. Me too. I had so many people send me this report, so that's why I had to get into it. But I do want to go ahead and get started. I've got a big, giant mouse now. It doesn't show as a big mouse. That's too bad. It shows as a big mouse on my side, but on your side, it does not. Thought that would be an interesting thing. But you can see where my mouse is. That's good. But let's go ahead and get started. And this, of course, is me, Stephen Thomas. I am a quantitative economics, decision sciences major, a housing geek. I am a housing analyst. That is what I do. And it's kind of my gig. I'm a quantitative economics, decision sciences major. You want to see a future economics degree, little kid. Let's see. Say hello. Who's this? Ezekiel. Are you having spring break now?
Yeah.
You don't have school for a while, huh?
Yeah.
Did you go to the park?
Yep.
Did Nana come over?
Yep.
What did you play with Nana?
Paint, Play-Doh.
That's fun. I love Play-Doh. That's fun. So say goodbye to everybody.
Bye.
Who else do we have here? The amazing Batman. No. Who's this?
Mason.
Mason Edward. Ready for some spring break?
Yeah.
Yeah, it's time to relax. You know, it can be hard being a kid. Time to relax, have some fun. Don't do much, you know. Maybe play a little bit of the, what is that game called? Switch. Yes, that's right. Play a little Switch. All righty, dude. Thank you. So Reports on Housing, your local real estate snapshot, that is who we are, and that is our company. I'm asking everybody to mosey on over to YouTube, watch Reports on Housing. So it's youtube.com/Reports on Housing. You'll be able to find us, and that's where all of our talks, all of our housing debriefs are stored there. So I want everybody to subscribe, and I want everybody to like it. And the reason I want everybody to like and subscribe is just for the YouTube algorithm so that more people can hear what really is going on in housing rather than all of the noise that's out there, because there is plenty of noise. So I'm inviting you to do that. Now, to get into some funny things, of course, have to start off with a little bit of levity. And thank you, Ryan Lundquist. He put the link for where to find it. You can hit that link that Ryan put on there if you're on Facebook, and go over to YouTube and watch it there. But anyways, this is actual listing, an actual house. Can you imagine what they did with this refrigerator right next to the sliding glass door? Just wow. I'm going to say that is a poor design. When you have to choose gas money or coffee money, coffee always wins. And then I saw this. I was going, I got to add this for my kids because they don't like sushi. So sushi for beginners. I think they might even do that. So, anyways, the Fed talks bubble. And I'm here to say that we're not in a housing bubble, but let me talk about what they are saying in this paper. The real paper that came out, it's actually part of their research post that they did, and it's at the Federal Reserve Bank of Dallas. It came out, this real-time market monitoring finds signs of brewing U.S. housing bubble. So that's what they're saying. They're saying signs. They're not saying it is a housing bubble, but they're saying there are signs. But as a result of that, of course, we saw CBS News, Federal Reserve warns of brewing U.S. housing bubble. And signs of a housing bubble are brewing. That's CNN. And then Fortune, a housing bubble is brewing, but not like 2008, says Federal Reserve Bank of Dallas. And this is from Bloomberg. Home prices suggest housing bubble brewing in U.S., Dallas Fed says. But I want, at the bottom of this article, it says, the views expressed are those of the authors and should not be attributed to the Federal Reserve Bank of Dallas or the Federal Reserve System. Now, even though they put that, you saw what all the headlines were, and it is the Federal Reserve of Dallas said this. So I do want to start off with that because it is a research paper and it has gone back in the past, and I'm going to go over kind of what it is. This is exuberance. They're going to talk, they talked a lot about exuberance, where the market is just a little bit too happy, too gleeful. It's going on all cylinders. It's just too, when I searched up the term exuberance, a lot of millennials came up. So I guess millennials are exuberant. And they are actually a big piece of the dilemma that we have with not enough homes on the market, and we have way too strong of demand, not because of low interest rates, but because a big giant demographic patch of first-time home buyers, millennials, have entered the marketplace with nothing to purchase. And this is exuberance. And they throw out 3 charts, and then there's a lot of dialogue about those different charts. And I'm just going to go over what those charts are. And if you see this gray area that's here, there's a gray piece right in the middle, and it starts at around 1998 and goes all the way till 2007. And that was 9 years where they said that the United States had housing market was too exuberant. So, and they do it with a 95% confidence scale, but they were calling it exuberant since 1998, and it went all the way to 2007. Now, on the right-hand side, that is right over here with my little arrow, you could see this gray area over here. This gray area over here is once we went into COVID, you could see that we've been dealing with a little bit of exuberance starting in about July of 2020. What caused our exuberance? 2 things, and we'll get into that. But number 1 are the low interest rates, and number 2 were not enough homes on the market. So we had way too much demand with the stronger demographic patch coming in, as well as no supply. And I want everybody to understand that this is not what we have today, but the subprime mortgage originations really didn't start to come into full swing until about 2002. And then 2002 on, it started to gain momentum. By the time they got to 2005 and 2006, we're looking at 23% of all loans were subprime, which meant that a lot of people didn't qualify, fog and mirror type of thing. And this was just some really ugly lending. So you can't really compare that big patch, that 9-year patch, to what we're dealing with right now, because what we're dealing with right now is a bit of our own home cooking, and it's not consumers that did the home cooking. It is the Federal Reserve and our United States government. We went into COVID-19, the pandemic, and everybody's eyes were wide open, and we were terrified when we first went into the pandemic in March of 2020, more than a couple of years ago. And that's when the Fed dropped the Fed funds rate down to 0. It was flatlined at 0. This ties everything from credit cards to automobile loans, but there's a lot that goes into this Fed fund rate, and bringing it down to 0 allowed even mortgage rates and everything else. Everything was all lending came to a much lower level, and that was when they dropped that Fed fund rate down to 0, and it remained 0 until last month. Now, they were also purchasing mortgage-backed securities at the tune of $40 billion per month, which that's going to prop up the market so that it functions not on its own, but that it makes sure that it functions and that there are enough of these mortgage-backed securities that are purchased. Those are all the loans that we put together in the real estate industry that are not above the jumbo loan limits, which this year is at $970,000. They were buying everything up to $40 billion per month, every single month, until they started to taper at the very, very end of last year, until they came down to zero last month. But they had the metal to the pedal. That's right. Okay. And then they did a lot of treasury purchases as well. And that helped bring the interest rates down to very, very low levels. And then you could see we started in COVID-19. That's where I'm pointing to. At first, the financial markets were a little bit broken and we had higher rates. But you could see rates got down to, by the time we got to July of 2020, we started to see rates that got below 3%. We were in the twos for the first time ever. As a matter of fact, after we hit COVID-19, that enough happened where people were buying just a lot of 10-year treasuries, and they're parking all their money into United States treasuries. And when they do that, it brings down, it's the same appetite for treasuries as it is for long-term assets like mortgage-backed securities and 30-year loans. So what we end up having are the loan rates going down. So we had mortgage rates going down. And as a matter of fact, we hit 17 record lows. 16 of them occurred in 2020 after we went into the pandemic in March, all the way to the end of the year. The 17th was in January of 2021. And that's where we hit an all-time low. And after that, it went up into the threes and then came back under the twos again by the time we got to August of last year. And then on the right-hand side, you can see over here, this is where we had interest rates start to skyrocket this year, where we went from 3% all the way up towards 5% mortgages. So it's actually about 3.25 up towards 5%. And then Washington, D.C. did their thing as well with a ton of stimulus packages and a lot of emergency stimulus that went into everybody's bank accounts across the United States, so that it would make consumers had more money to spend. Not everybody was in a financial pickle, but most everybody got some sort of a stimulus check. So when they got these stimulus checks, it helped feed the economy after we shut it down to next to nothing. So with the combination of everything the Fed did and the Washington, D.C. did, that's where we got a lot of stimulus. And then you can see, as a result, we could see it in these indexes. This is the second chart that the Federal Reserve put together, and this is the U.S. price to rent ratio, rapidly diverging from fundamentals is what they're talking about. What they're talking about is this is the price to rent ratio, and it's starting to really climb. And they're comparing it to that middle blue part where you could see that the price to rent ratios were out of whack. Now, it's not out of whack because of fraudulent lending or anything like that. It's more out of whack because more than anything else, there's kind of a lag in rents. The rent of a primary residence in the United States, this is the CPI's version of what's happened with rent. You can see it actually bottomed, and this is what the government uses. And it actually bottomed over here in May of 2020, where it started to come down after we went into COVID. And in May of 2021, then it started to climb. So there was definitely a lag in when the rental inflation really started to surge in the indexes that the Federal Reserve likes to follow the most. There are other indexes that show that this wasn't quite the dip, but I'm showing you kind of what they rely on more than anything else. One of their faves is that CPI. Now you look at U.S. price to income ratio increasing quickly, but not yet exuberant. So what they're saying is that people's incomes have been rising, and it's not yet at an exuberant level where we're overpaying for properties, but it's right now getting to where people are overpaying because we had a spike in interest rates recently. So This shows you where the exuberance scale. You can see here in the middle where the orange is. That was prior to the Great Recession, where you could see it happened for a little bit towards the end of 2000, middle of 2002. Then it happened in 2003. Then it happened in 2004, 5, and even in 2006, and at the very, very start of 2007. And you could see that there was an issue. And what that was is people were really they were paying more than they could really afford to pay. And this is kind of what they're alluding to, that we're getting close to. But when we're not doing dumb things like fraudulent lending and ridiculous things, it's going to slowly but surely stop on its own, because people are going, okay, what does all of this mean? And what I really want you to understand is that really happening behind the scenes of the market is we've had the expected market time drop down to a very, very low level, all-time low levels. For all of Southern California, it was right around 25 days. We had San Diego at 18 days, and Orange County at 20 days, and Riverside at right around 20 days as well, and Los Angeles is at 28 days. So we have these really low market times. And when we look at where we are today and go back in time, you could see we are very, very at very, very hot levels where the market's not really behaved here before. You could see in the middle, there's 2013 over here. This was the hottest market that we'd ever seen prior to that. And it was below 40 in the 30s. And that's where it starts to get insane, anything below 40. And you can just imagine how insane the market is today when it's right around 25 days. But I want to go backwards in time and show you that this was the expected market time going back in the past. And you can see over here, we have an expected market time where it is just in the dirt. This is Orange County. And the reason why I bring up Orange County is because I have the data that goes back further throughout the Great Recession, because I followed the Great Recession and knew that there was a problem all the way back in 2000, at the end of 2005 and into 2006. Because in 2006, we had a 200-day expected market time. I was already waving my hands and I knew that there was something wrong. I am going to see it in the data when there's a problem and there's a bubble brewing. Right now, we have an expected market time that is so low. That means that we have very, very low supply and a lot of demand. I keep on wondering where in the world we're going to get the supply that is going to feed this popping of the bubble that everybody is talking about. Because you need a lot of people unemployed, and you need a lot of people that are just clamoring to sell their homes, and they have to have very little equity for it to really have falling prices. And that is not what we have today. And you can see that this is the CaseShiller index. This is where this came out this week. Right now we have year over year increases for January at 19.2%. It increased from December to January, and it's already off to the races. This is across the country. We're looking at 19.2% gains across the United States. And this is too hot given where today's interest rates are. So a lot of people are talking bubble. And wait a minute, speaking of bubbles, I'm going to introduce a couple bubbly people really quick. And I've got bubbly person number one. You feel a little warm. She rode her bike home.
Yeah.
Right on. How's it going?
Good.
What are we doing this next week?
Well, it's spring break, so I don't know yet.
We're breaking for spring.
Yeah.
That's what it's about. Yeah. Pretty cool. Schedules, fun things. Come over here, little girl. Who's this? Bubbly personality.
I'm not a bubble. I popped the bubble to spread my bubble way bigger around the whole entire earth.
Okay. What's your name?
Athena.
You ready to rock and roll this weekend?
Yeah.
And this week?
Yeah.
Right on. She has a soccer game tomorrow.
What?
Great. You do not, and you don't have to ref tomorrow. I'm refing.
I thought, it was canceled.
No. Anyways, let's talk about the bubble. Now, here's what everybody needs to understand. Everybody's head automatically goes to Great Recession. I had to dust this off. I did this back in April of 2020 because everybody was panicking about what was going to happen in the market. And so they started talking about the Great Recession, because that's what happens. Everybody thinks recession. Everybody's talking recession recently. Matter of fact, I have 6 different flags that go up for the recession. 3 of them are already raised. And that all happened within the last few weeks, but just within the last month, actually. But just know that just because it's a recession doesn't mean housing's going to tank. that is not 4 out of the last 6 recessions did not affect housing. The 2 that did were the savings and loan scandal of 1991 that real estate caused, as well as the Great Recession of 2007, which the real estate sector caused. So it's when the real estate sector causes it, that's where we have a problem. This is not the real estate sector did not do anything out of bounds this time. So that's where they're a little bit insulated. So it's not going to be the Great Recession. As a matter of fact, the Great Recession housing market, there was an inventory glut. There was way too many homes on the market. And when I'm talking more homes on the market, I'm talking like in Orange County, 10 times the number of homes where there are today. There were 16,000 homes in 2006 versus 1,500 today. Subprime and pick a payment plans were in vogue. We had fraudulent lending. We had no down payments. We had a ton of adjustable rate mortgages. Everybody was buying these teaser rates to get just, shoehorn their way into a house. And we had a flood of cash out refinances and very, very limited equity. Because people were putting such little amounts down, they were exposed to the market, especially those people that bought towards the top. And that's why some people are so concerned about buying towards the top. They're saying, Steven, is it a good time to buy? If you're asking me if it's a good time to buy, it's not a good time to buy. If you can afford the payment and you have a good job and you can afford to live in your house for the next 5 to 7 years, who cares about what the market does? Buy. That's the bottom line. As a matter of fact, you buy today and you have interest rates today. I can tell you this: within the next 7 years, I can almost put my 100%. I'm going to call it a 99.9% stamp guarantee that we will have lower rates within the next 5 to 7 years, where you'll be able to refinance into a incredible rate. So now let's compare the Great Recession housing market to the current housing run. An inventory crisis, a catastrophe of very few homes on the market right now. Very, very tight qualifications continue. There is no subprime and fog and mirror loans. You have to have their strong credit scores are winning like crazy. Large down payments are winning like crazy, and cash. Fixed rate mortgages, 90% of all mortgages are fixed rate. Unbelievable nested equity. That's a ton of equity, not artificially built on the back of subprime and pick a payment and adjustable rate mortgages and dead people getting loans and dogs getting loans. You understand, this is not the Great Recession. And now that I've shown you kind of the difference between then and now, do not be scared of any kind of a slowdown in the economy. It will slow down our housing market, but right now it is way too out of control. The Fed realizes it, and I'm sure they're more than happy with that article making all kinds of headlines. And even though there's a disclaimer at the bottom, the Fed wants to tap the brakes on the whole economy, and especially housing running away and continuing to get to some unhealthy areas as far as affordability is concerned. But know that as far as real estate is concerned, it doesn't change things in a snap. It just absolutely does not. As a matter of fact, I used this analogy before. Last time was 2 years ago. It's like for the market to make a significant change, it's a really slow, methodical change. It's like a big, giant cruise ship like this trying to make a U-turn within a harbor. That's just not going to happen. So they want the market to slow down. It will slow down. It doesn't happen in a snap. We've had these interest rates snap up towards 5%. And as long as we're at 4.5% plus on interest rates, it's going to create cracks in our market, and the overall market is going to catch a cold. That is what is going to happen as long as these rates remain where they're at. And I have news for you as to where I'm already seeing cracks. But first, let's get into our sponsor. Our sponsor, my buddy, your buddy, Kevin Buddy at Monarch Coast Financial. He deals with, of course, more than one kind of borrower. So there's more than one kind of loan, everywhere from full documentation loans to alternative documentation loans to investor financing and private money. So pretty much everything you need as far as lending is concerned. Has loads and loads of experience. Has been doing this since 1976. He took care of my family, helped us in our refinance, and they did an absolutely incredible job. I was so pleased with how he took care of my family. So if you need help for yourself and your clients, turn to Kevin Buddy. He's my buddy, your buddy, Kevin Buddy at 949-422-2075. That's 949-422-2075. Kevin Buddy at Monarch Financial. Thank you for your continued sponsorship, Kevin. Now, let's get into where I'm seeing those cracks. But first, this is interesting because the inventory, we snapped it today. It's as of from 2 weeks ago to today, it's gone up 353 homes. Now, that's not a ton. It's not screaming upwards, but yet it is going up like it has not in several years. And that's actually decent news. So we're going up in the right direction, where if it continues to go up this direction, as long as we have rates that with duration that stay at or above 4.5%, it is going to continue to march until we have more homes this year than last year, and it hit where we were in 2020, the green line. So we'll surge right past that red line up towards the green line and peak during the fall, where then it'll start to come down and we'll be pretty even with where we were at the end of 2020. So last year we were at 15,395. That's 13% more. That has been dwindling in time from the very start of the year. You can see over here, this is the very start of the year, and this is where we are right now. That difference is only 13% more last year than this year. The 3-year average is 35,877. You can see where we need to be. Where we need to be right now is right about where this box is at 36,000. So a little bit higher than at the bottom of that box is where we should be. So that's how much inventory we are missing right now. That's 163% more than where we are today. Now, the new for sale signs right now, if we compare what's coming on the market prior to COVID, last week I showed you 2020, 2021, and I did the first 2 weeks of March. I updated it for all of March. So I wanted to bring you that. For January, we were missing 5,000 homes. A little bit of this had to do with Omicron, but it was down 23% compared to the 3-year average prior to COVID, 2017, 18, and 19. February was off another 2,600 homes, off 13%. That's 7,600 homes. In March, we're off another 3,400 homes, down 13%. Now, March is where we start to see more homes, but we're missing still a big chunk of homes. This is entirely because there are a lot of people that just simply are not moving right now. It's too hard for them to make a move. They're prisoners of their own home. And if you look at January, February, March, those are the orange lines. It is definitely muted compared to where we've been recently. And this goes all the way back to 2017. It's the lowest levels other than this month going back to last year. 2 years ago at the start of the pandemic. So not quite like it was at the start of the pandemic, but still not enough homes coming on the market right now. And that is a new trend that I'm following. It's this year. It started at when interest rates started to rise. And I think this trend is going to continue of fewer homeowners placing their homes on the market because they have such a good rate. They know their values are already good. They don't want to make a move up because it just doesn't make dollars and cents for their family. So that was the big thing of where will I go? They want to stay put. A lot of people are staying put. And if you want me to try to convince people to purchase, I've already told you, if you want to make a move and know that down the road that if it's good for your family, then do it. If it makes sense to you, then do it. And then refinance down the road. I ask lenders in all the meetings I do, how many times can you refi? Unlimited number of times. So you can refinance over and over again if you so desire. So just know that if you're locked in at these higher rates, refinance boom will be back down the road once interest rates drop again down the road. And as far as SoCal demand is concerned, yes, it's been like this, but I'm going to say that the line is starting to diminish a little bit. It's still long. It's just not as long. We're getting multiple offers, not as many multiple offers. This is what we're hearing across around all throughout the trenches of Southern California and also the Bay Area and Phoenix and Las Vegas. I'm looking at all those markets. Now, what's happening is buyers are beginning to look at how much the payment's going to be if they make a move, and they're saying, no, not right now. So they're pulling out. And as a matter of fact, you can see it in this line. Today, this is demand. This is the last 30 days worth of escrow activity. Now, I wish this graph actually showed you what the difference was from last week to this week, because there was already something, it was going up last week. And then when it dropped this week, it was a significant drop week over week for all areas. But you can still see what's going on here is today is flat. It's usually going up, and it's not right now. You can see right here, it's actually dipping below 2019 levels, and it's down 55 net pending sales for a 2-week period of time. Usually this is where we're having a rise. Last year, we were at 19,717, which is that red line, 21% higher than where we are today. The 3-year average prior to COVID is 17,292. So where we are today is muted compared to the 3-year average. That's 6% higher than where we are today. And the average rise for this last 2-week period is 5%, and we had no rise. So there is the crack that I'm seeing. I'm actually when I'm looking at this on a weekly basis and looking at last week compared to this week, that's where I'm really seeing the crack, because from last week to this week, we actually dropped 2.4% in demand for Los Angeles. In Orange, it was down 1.3%. In Riverside, it was down 2.7%. In San Bernardino, down 2.8%. In San Diego, down 2.8%. For some reason, San Diego always does things first. They're the first to go up and have an exuberant market. They're the first to come down, and they're a leading indicator for what I think the market's going to do as a whole. So that's kind of the crack that I'm seeing in the marketplace right now. So how fast is this market moving? Well, it's still moving fast. It went from 24 days to 25 days within the last week. So it went up 1 day. And last year at this time, we were at 23 days. So that's something to note, because it's the first time that the expected market time year over year is actually higher than it was last year. That dates back to May of 2020, when we first went into COVID. When things started really getting good in May of 2020. So you can see that the market time is right now beginning to slow, where we're starting to get readings. This is the second sign that I'm starting to see a crack emerge here as well, and we'll see where it goes within the next couple of weeks. The 3-year average is 63 days, so we're still extremely hot. We're just coming off of insanity market to slowing it down. Appreciation, if we continue to stay at or above this 4.5% level in interest rates, mortgage rates, we will actually see the marketplace continue to slow. And so if you want a copy of this, I'm going to invite you to subscribe, because everybody that subscribes automatically gets a copy of this report. And you go to reportsonhousing.com, you click on subscribe, and you can use this QR code to go ahead and subscribe. I keep on forgetting to update the coupon code. The coupon code has expired. I'll actually have to do this over again. But we have reports that dot all over Southern California. We'll be branching off to the Bay Area later on this year, and it's $15 per month or $150 per year. And you get a month free if you sign up utilizing the coupon code March. I'll make it good for the next week. And Out of Control was the most recent one that came out. There is a new one that's coming up on Monday, and we'll just have to see what I write about after I look at it. But that's pretty much sums up what our market is. It's kind of like out of control right now, but with everything that's going on with mortgage rates, it's beginning to shift the market. But like I said, it is a cruise ship, and that cruise ship, it just tends to slow things down a little bit. It absolutely does. I'm going to stop sharing, make myself bigger, and just know that it does take time, because we have these higher interest rates, and after a while, especially the second half of this year, and I'm actually seeing these cracks emerge earlier. I thought that I'd see the cracks like in May, but I think I'm seeing them a month earlier because of how quickly the interest rates rose at the very, very beginning of this year, from the end of December through February, and then on through last month, where we got quite a rise. Because of this rise, what we're going to see is that there's going to be buyers, because you have to qualify for everything, and they're looking at their bank accounts, and they're looking at their jobs, they're seeing how much is what's good for their family and all that stuff. There will still be an appetite to purchase. It's just there's not going to be as big of an appetite to stretch above the asking price, because there's enough negative news out there that people are going to be a lot more cautious about their purchases. So properties need to be priced at the last comp, especially as this year progresses. And I just ordered from a residential sign company a whole bunch of overpriced sign writers. I'm going to bring them to my meeting so that I can share. I'm going to auction them off to whoever it is, not auction them off, but we'll do a little raffle in the various presentations that I have, because we're going to be dealing with overpriced properties, and you're going to need price reductions because buyers are not going to be as willing to stretch. And there's going to be a lot of sellers that will still overprice. And when they overprice, what's going to happen? They're going to sit on the market and they're going to accumulate, and we're going to get an inventory that slowly but surely builds and will actually peak later in the year rather than the summer, all the way in October, because that's what happens in the marketplace of when we have the interest rates that are rising. So you get demand that diminishes a bit, so that you get the inventory that rises on the backs of overpriced listings. And then we get market times that slow. So you're actually going to see that rise in market time. So with a rise in market times and lower demand, you get a slowdown in the overall marketplace. But for all those homeowners that are expecting it to be that bubblicious thing where it was behaved just like the Great Recession, I just showed you why that's not going to happen. Instead, we're going to go from 20% appreciation, maybe down to like 5% appreciation. And if we have inflation that continues to do this, it'll actually could outstrip what's going on in housing. We're just going to have to see. But what's the big thing that you need for everything to slow down? Supply. And we need a lot of supply for there to be any kind of a shift. And we'll see this thing happen over time. We're not going to get to 35,000 homes on the market anytime soon. There's not going to be a flood of homeowners coming on the market. I just don't see where it's going to come from. I just don't understand it. So what is the coupon code? Justin Butler, the coupon code is March. And just keep on using that one, even though it's the month of April. But my reporting numbers, it says today, it's actually through March 31st. So technically we're still okay. Anyways, I hope if you have any questions, go ahead and put them in the chat, and I'll be more than happy to get to them. Please subscribe at Reports on Housing on YouTube, like my videos so that the algorithms work and more people actually watch them. And I'll continue to bring this great information on a weekly basis. Hope you have a fantastic weekend. And if you got kids like me in South Orange County, we got spring breaks. So we're going to have some rugrats all over the place. As you can see, they're pretty excited just to chill a little bit. So we'll see you on the other side of this weekend. We'll see you next Friday. Have a fantastic weekend, and just enjoy yourselves out there.